assessing the effectiveness of the stock market. And before giving the word to our presenter, let me introduce our participants and guests. Some of them are just coming, but nevertheless, we start our webinar, and I am glad to greet, first of all, our Vietnamese colleague, professor of Banking Academy of Vietnam, and personally, Professor Chan Hy Suan Anh, Nguyen Thanh Phuong, Pham Tien Man. We greet you. And it is our pleasure to access you in the framework of our webinar. And now I will introduce the reporter and participant from the site of Financial University. First of all, I will greet our professor, the member of Russian attestation committee and head of financial management department, Igor Lukasevich. Next, I greet our professor, member of Russian Attestation Committee, head of Financial Market and Financial Engineering Department, Boris Rubtsov. Next, our guest is Dean of International Economic Faculty, Relation Faculty, Alexander Didenko. Okay, and Lazarev Mikhail, PhD and member of Financial Management Department. It's here. And group of our under and postgraduate students. We are waiting for participation the representative of State Plekhanov University and representative of RANG. Before giving words to our presenter, I should remind the time limit of our reports. Each of our reporters, dear colleagues, you have 10 minutes for your presentation each, and after that you should answer the question regarding your presentation and small discussion. The limit of our discussion 10 minutes too. So keep your timing, and now it's turn of Igor Lukasevich. Please.
Good morning, everybody.
Зачем? Давай.
I would like to present my research that devoted testing market hypothesis, or MEH. As you know, hypothesis is one of the most influential theories. Proponents of this hypothesis argued that if the market consists of a sufficient number of participants, then their actions would force the market price of a security to its equilibrium value. So if the MEH holds, then investor would be unable to earn abnormal returns from either fundamental or technical strategies. Though the MEH questioned the usefulness of fundamental and technical analysis. On the one hand, studies have provided support for the use of trading strategies based on some fundamental and technical principles. On the other hand, the MAH has provided fundamental and technical analysts with some new methods, as well as introducing statistical tools for evaluating security. In this study, we examined the efficient market hypothesis for the emerging markets like Russia and Vietnam, and compared them to the United States market. So now you see three forms of efficiency: weak form, semi-strong form, and strong form. So, weak form of capital markets efficiency means that current prices reflect only the information contained in the best prices. Current prices reflect all information that can possibly be known to anyone. Semi-strong form of capital market efficiency said that current prices reflect all public available information. And strong form, all information affecting the asset's value. So as we know, in efficient market, prices reflect all available information. So when new information arrives, price must react continuously to it. Since new information is that which cannot be predicted, it will arrive at random points in time, and price movements are random. This is very important for testing hypotheses. Now we see example that good news, when it is announced, should increase the price of stock quickly. Otherwise, there is an arbitrage opportunity. Of course, have different reaction. Next slide, please. To the good news. Now you see that there is some other reaction to good news. Next slide, please. And now we see sometimes the price underage. Next. Of course, opposite is also true. So if we have some bad news, prices will reaction immediately. And that bad news, when it ignored it, should decrease the price of the stock. Next slide. Next. So, what is the tools for studying concept? Different tools, especially filter rules, serial correlation tests, run tests, and so on. Next slide, please. Now we have example using filter rule. You see, if a security price rises at least 10%, can buy and hold until the price peaks and falls by at least 10%. When price decreases from peak level by 10%, liquidate long position and sell short. A lot of features ranging have been tested. In general, filter rules generate large commissions, especially if you have small values. Many studies were shown that filter rules don't outperform naive buy and hold strategy, and many studies have failed to detect statistically significant serial correlation on a daily, weekly, and monthly. But scientific evidence supporting weak form efficiency of the stock market. Of course, while most of scientific evidence supports the weakly efficient hypothesis, some anomalous evidence exists. Next slide, please. And well-known anomalous are January effect, day of the week effect, and so on. Next slide, please. Now you can see January effect for different countries, and maybe that it's interesting that internationally January effect is even stronger than in the US. Next slide. Of course, we have tests of semi-strong efficiency by study reactions to government announcement or reactions to corporate news. Next slide. And there are also anomalies, especially size effect, gross value anomaly, price to book ratio. Next slide. Our approach to test this hypothesis using first exponent, and the first exponent is now this time series measure, but Aaron first was originally used in hydraulic engineering. But in finance, the first exponent is used by price pattern hidden with random stock price trend. In general, a time series can be persistent with a tendency to continue up or down patterns, or articles, which it has a higher tendency to reverse the current pattern or random. First exponent can be used to test for randomness. So it's how good. As you know, if the price trend is random, the first coefficient would be continuously have a value close to 0.1. Next slide. So now you can see testing Ho Chi Minh stock index of Vietnam stock market, and as you see, first exponent is equal 0.73. So we can say that stock's price patterns for the Ho Chi Minh index exist. Next slide, please. Now you can see first exponent of the Russian MyCPI index. As you see, still close to 0.6.
Там плохо видно, садитесь вот здесь, чтобы видно было.
So we can say that Russian market also. Next slide. And now you can see this picture of the studying first exponent for the USA market, especially for S&P 500. And as you see, you can say that it's very close to ideal 0.5. So say that for this period of time, say stock market, and next slide. It's very interesting that you say market is not efficient take a longer period. For example, you can see that first exponent is more than 5, so all the period is an American market. Thank you very much for attention. Next slide, please. There are some conclusions and questions.
Okay, thank you very much for your presentation, Игорь Ярославович. And now it is time for our discussion. Не загружайте пока, мы же будем спрашивать. Dear colleague, do you have any question to our presenter?
I heard you present about a little bit about the Vietnam Stock Exchange when we applied to test the weak form of Vietnam Stock Exchange. Is that right? Could you hear me? But I'm not quite clear about the conclusion about Vietnam Stock Exchange. So can you share with us a little bit about the result?
Dear Vietnamese colleague, we obviously have some problem with sound. Can you repeat your question and type it in our SMS field?
Yeah. I have a presentation that he applied to test the weak form of Vietnam Stock Exchange. He collect database from Ho Chi Minh Stock Exchange. Is that right?
I don't hear very well. Please type it your questions.
In the question?
Type your question, please.
Yeah, we are doing.
We are waiting.
Did you get it?
Игорь Ярославович, did you get it? The question of Vietnamese.
Yes, okay.
Answer, please.
And please slide 22, maybe 21.
Yes.
21. Так в другую сторону листайте. 21 слайд.
22.
Okay.
21, I get that.
No, previous.
Vietnamский.
Yes, okay. Yes, okay. So you can see that first exponent for Ho Chi Minh index is equal 0.73. Yes. So we can set that Vietnam market is not efficient because first exponent is more than 0.5.
Do you suggest something for Vietnam Stock Exchange to improve the market. Improve the efficiency of the market. I will.
Igor Yaroslav, did you get the question?
We try the question. Do you get it? Did you get
Yes,
it?
yes, yes, yes. Well, I unfortunately I can't because it's market and it's maybe government problem. So if there will be a big number of participants, if they will have good and full information, maybe the efficient of the Vietnam stock market will be better.
Thank you very much for sharing.
Thank you.
Unfortunately, we have time limits, and now I give the word to our next presenter, and it is turn of our Vietnamese colleague. Please wait a minute for loading your presentation, and then we start your report. I remind that the next presentation is from Banking Academy of Vietnam, Professors Chan Thi Xuan Anh, Nguyen Thanh Phuong, and Pham Tien Minh. Colleague, please, it's your turn.
Yeah. I would like to present our research topic. It's semi-strong form efficiency, the market reaction to dividends and earnings announcement in Vietnam Stock Exchange. Next, please. Our contents includes introduction, previous literature, data and hypothesis, and results and discussion. Next, please. As you know, the efficiency market hypothesis is one of the most important issues in the modern financial literature. As you know, it considers 3 degrees: the weak form efficiency, semi-strong form efficiency, and strong form efficiency. The semi-strong form efficiency holds for a certain market if all available information is publicly reflected by current market price. It implies that stock prices are not only reflective of past information, but also on publicly available information on the market. Semi-strong form efficiency is generally tested under 2 approaches: the direct method supported by event studies and indirect methods that conducted by performance evaluation studies. In Vietnam, as you know, we have 2 stock markets, Hanoi Stock Exchange and Ho Chi Minh Stock Exchange. The purpose of our research is to test whether Vietnam is efficient in semi-strong form by identifying the market's reaction to public information and events. Next, please. In the previous literature, most of the research regarding to the efficiency market in Vietnam only focus on the weak form efficiency. Regarding to the semi-strong form efficiency, Aharomi and Swary in 1980, they concluded that New York Stock Exchange, there is no evidence of market efficiency when the 2 types of announcement, which are dividend change announcement and quarterly earnings announcement. In 1997, in the U.S. stocks Emerson conclude that the dividend decrease announcement of public utility holding companies have a stronger market risk compared to unregulated companies. And in 2010, Baharudin et al. They researched on Malaysia Stock Exchange, and they conclude that there are some evidence of semi-strong form efficiency in the market. And our contribute to test whether Vietnam Stock Exchange is efficient in semi-strong form, and also to investigate the issues of evidence changing announcement from multi-industry and its price reaction together with the earning announcement. Next, please. In data, we use event study methodology with the data was collected from 7 listed company in Ho Chi Minh Stock Exchange in 2014 and 2015. And we follow the research of Baharudin et al. 2010 with some assumption that when both dividend and earning increase, or dividend increase but earning decrease, or dividend and earning decrease, both of them are decrease, or dividend decrease but earning increase, and then dividend unchanged but earning increase, and dividend unchanged but earning decrease. Next, please. And we follow the 9 dividends and earning expectancy model. As you can see, it states that when dividend can increase, decrease, or unchanged, the similar with the earning increase or decrease. Next, please. Next, we estimate the abnormal return by using market adjusted abnormal return model, and we assume that alpha equal 0 and beta equal to 1. For each stock, we calculate the data return, and then we calculate the dynamic cross-sectional average abnormal return for the certain event day. And then we calculate the cumulative daily abnormal return. And we have 6 hypotheses. With hypothesis 1, there is no significant difference between the cumulative average abnormal return before and after dividend increase and earning increase announcement in the Vietnam Stock Exchange. Next slide, please. And hypothesis 2, we also test with the dividend increase but earning decrease announcement. And hypothesis 3, we test on dividend decrease but earning increase. And hypothesis 4, we test on both dividends and earning announcement decrease. And hypothesis 5, we test the dividend unchanged but earning increase. And then the hypothesis 6 with dividend unchanged but earning decrease announcement. And then it is the results. Next slide, please.
I would like to present our results on the research. So we divided the result into 2 main parts to answer 2 main questions. The first one, we answer the question how the share price react to the dividend announcement. And the second part, we answer the question how the share price react to both information of dividend and earning announcement. So you can see from table 1, that is focused on the question how stock price react to the dividend announcement. We divided by 3 main groups of dividend: increase, decrease, and unchanged. So at the first column about dividend increase, you can see that there are some abnormal return happen on day 0, day 6, day 8, and day 9. We highlight by the yellow color. So it means that before dividend announcement date, we see some abnormal return. But after that, we see insignificant abnormal return based on the good news of dividends. For the next column, we present about the reaction of the market to dividend decrease. Of course, there are some abnormal return also happen around the day of around the dividend announcement. But when you look at the table, you also see that there are insignificant abnormal return happen. The same for the last column about dividend and trends. So to more detail, we go to, please, next, go to the slide, please. Next slide, please. Yeah. To more detail, we go to the cumulative abnormal return surrounding announcement of dividend. It's very interesting when you look at the figure 1. No matter what the dividend increase, decrease, or unchanged, we see the uptrends of cumulative abnormal return curve for the whole period. The same trend. When the good news of dividend leading to the share price up, but a little bit difficult to explain why dividend, in case of dividend down or unchanged, the cumulative abnormal return still happen. I mean, it's still uptrend. We find some information beyond the fundamental factors, and we think that maybe in the emerging market like Vietnam Stock Exchange, the share price not only impacted by the fundamental factor, but mostly impacted by the non-fundamental factors. Next slide, please. Next slide. Next one, please. Next one. Yeah. For the second question, the table 2. Can you come back to the table, please? Could you come back to table 2? Yeah, that's one. To answer the second question, we compile both information of dividend and earning announcement, and we test how those information impact on the share price. So when you look at the table 2, we divide it by 6 groups differently. When you look at the panel A, dividend increase combined with the earning increase, and we can see that we have a 2 group. Earning increase come up with dividend increase. So we look at the abnormal return and cumulative abnormal return. We also see that there is a little bit abnormal return happen in those days. I mean the surrounding announcement date. And next slide, please. Next slide. And when we compare the reaction of the market to only dividend information and the reaction of the market to both information, including dividend and earning increase, we see that the market reacts strongly to both information. I mean, if the investor, they get good news from dividend and earning, the share price should be increased surrounding announcement date. And you can see, we see there is highly abnormal return from day 4 to 0, compared with only dividend information come out to the market. But it's very interesting when you look at the figure 3, the cumulative abnormal return is same trend for the both dividend up or down. They have combined with the earning announcement. And it's very, very interesting or surprising with us, because in the case of the good news from dividend and earning, the uptrend is clear. But when good news from dividend but bad news from earning, but the market is still up, that is a question for us. The next slide, please. The next group, we analyze how dividend downside combined with the earning upside happen, how the market react. So when you look at the figure 4, you can see that if the investor, they receive the good news from earning but bad news from dividends, the offset effect happen. So that's why we can see the highly abnormal return happens surrounding 2 days of announcement date. But when you look at the figure 5, sorry, we see that if even the dividend decrease, I mean bad news from dividend, but if the market receive the earning of the company stay good, they increase, the reaction is very well. The market is uptrend. But if the earning is downtrend, absolutely the market is downside. That is correct with the theories. Next slide, please. And the last one, we analyze if dividend untrends, how the market reacts in the case of the earning increase or decrease. And when you look at the slide, you can see if the dividend untrends, if the earning of the companies is increased, linked to the share price uptrends. And for the other case, the price behavior just remain for the long term. Next slide, please. So in summary, we think that next slide, please. Yeah, that's one. We come before we mentioned that we test stick hypothesis from H1 to H6, and here is the table summarize our result. And when you look at this one, we can see that we just accept only H4. It means there is no significant difference between the cumulative annual return before and after dividend decrease and earning decrease. For the other, we reject. So it means that, next slide, please. So it means that our research not support for the semi-strong form of Vietnam. And we think that there is insignificant reaction to the announcement date itself. It means that take a long time for the market react to the good news or the bad news from the company in terms of dividend or earning announcement. And next slide, please. And based on that, we also provide some recommendation. The market is not semi-efficiency. So in the futures, of course, the government needs to do something to encourage listed companies release timely their finance statement, and they should undertake policy to ensure the market economy stability. And the future research should be considered the largest sample size and also broaden scope of our research to give the reasonable conclusions. So thank you for sharing with me about our research.
Thank you, our Vietnamese colleague, for your interest in research, and I'm sure that deputy editor of our Roberts Journal is satisfied with your result and certainly invite you to take part in our next issue.
Yeah, I'm not sure you can follow us because
Sorry.
I think the transmission lies is not quite clear, right?
Thank you very much for your... Меня слышно точно? Потому что я себя не слышу. Thank you very much for your nice presentation. Results are quite good, and as a deputy editor of Review of Business and Economic Studies, I had only one question. Have you already published that result?
Could you,
have you already published that result?
Cannot the question clearly.
Yes, sure. Just a second. Нормально. Давайте, там все классно. Я бы сам так написал. Я просто не видно. Класс. D.
No, not yet.
Давай я напишу. У меня хватит рук длины.
We have not published our research before.
To publish a paper in...
Alexander Didenko is deputy editor of our spoken magazine, scientific magazine, Robis. And as far as I understood, he invited you to be published in our next issue.
Very happy to hear that.
All right. Thank you. Слушайте, вы уверены, что они...
Dear Vietnamese colleague, we have such question. Can you hear us explicitly?
Yes.
I mean
I can
our
hear you very clear.
presenters. Yes, and let me introduce once more our next presenter, entitled of Dean of International Economic Relation Faculty, Alexander Didenko. Please. Oh, sorry. I absolutely forgot. I apologize for how absent-minded I am. Questions to our Vietnamese colleague from our audience.
Excuse me, dear colleagues, could you answer how many Vietnamese companies did you use in your research, first of all? Second, what is the dividend payout ratio, average, or maybe average for the Vietnamese companies you studied? And third, how many Vietnamese companies from those who are quoted at both exchanges pay dividends?
Actually, in Vietnam Stock Exchange now we have around 820 listed companies, and we collect all of them. But there is only 247 companies, listed companies, miss our requirement standard. We set up 3 main standards for our research. The first one, there is no other relevant company information public on day before, during and after the dividend and earning announcements. And those companies are listed on stock exchange where daily stock prices are available to collect. And the several companies have to list on stock exchange before January of 2013 to have all information needed to compare the data collected from January 2014 to December 2015. So that's why among listed companies, more than 800 listed companies, my research just collects 247 listed companies meet our requirements. You get it?
Yep.
Did you calculate ratio? Payout ratio. Payout. Entering. Is it?
That the cash dividend payment. That is the cash dividend payment.
Sorry, dear colleague, but I am forced to interrupt and quit our discussion. And now it's turn of Alexander Didenko. Please.
Thank you.
Hello everyone once again. Можно на меня, в принципе, перевести камеру. Не слышно. Hello everyone once again. My name is Alexander Didenko. I'm Dean of International Economic Relations Faculty. And today I want to talk about the strong form of efficiency of global market. So previously we have discussed how effective is Vietnamese market from the point of view of just weak efficiency. So could we use information about prices to earn abnormal returns. Then we proceeded to questioning the issue of can we use information about past fundamental data, but public information about fundamentals to earn abnormal returns. And in my presentation, I want to question some other issue. Are there any market participants that could use price information, public information, and partly closed information to earn or actually to predict market? Next slide, please. So what is market efficiency at all? We already discussed that. We have information. Information goes to participants. Market participants are somehow processing that information, and then they make trades. And during the process, information is thus revealed in price. Next slide, please. So in a series of previous research, which I have presented about a year ago on that seminar, we showed that we tested whether sell-side analysts which reveal information about their recommendations, whether these sell-side analysts could actually predict market. And we showed that no, they couldn't for almost any market in the world. The method which we used was quite widespread, much in the style of FAMA French portfolios. We just made opinion portfolios. So we took consensual target price or consensual recommendation of analysts for every stock. Then we took first quantile of portfolio, so the most recommended stocks, the lowest quartile of portfolio, the least recommended stocks. Then we took differential returns, and we tested the hypothesis of difference between differential returns of opinion portfolios and zero. And we came to the conclusion that there is no actually any difference, so which translates to human language as follows: there is no any there is no any difference in what analyst is telling to you, whether he is recommending buy or sell the stock. It is not connected with the future of that stock. Now, next slide, please. So here, for example, we can see blended forward 12-month history of recommendations of some analysts about Microsoft price. And you see that, well, predicted price and historical price given by a single analyst is very rarely coincides. But interesting thing happens when we are aggregating, next slide, please, when we are aggregating recommendations of all analysts covering Microsoft price. You see that dynamics, when we aggregate and take consensual price, that dynamics become to look more similar to dynamics of historical price. So we took blended forward 12-month predicted price, then we took historical price, and we shifted blended forward 12-month price 50 weeks to the past, so that we can see exactly the price which was predicted 50 weeks ago and actual price. Next slide, please. The most interesting thing becomes when we start to aggregate not only recommendations of analysts over single stock, but when we are taking some index, for example S&P 500, which is comprised of stocks, of different stocks, and when we actually 502 stocks currently, and when we start to aggregate not only analyst opinions across one stock, but analyst opinions across stocks, and then we sum up stocks to form like predicted index, you see that the dynamics is well quite is speaking toward the ability of analysts to predict something. We at least see that during, well, so-called calm times, when nothing happens, they are almost predicting the level of the price, not the return, but the level of the price. Only the shaded period corresponds to Lehman Brothers crisis, and you see that during that period, the crisis was exactly the event which nobody managed to predict, which actually could speak for well, efficiency of the market, at least in strong form. So people which are using non-public information as well as public information and price information could predict, well, on aggregate, on average, the market, not separate people, but on average, market could predict the level of the index. Only during periods of crisis, which was really unexpected event, nobody managed to predict that thing. So how can we use that? Next slide, please. Well, first of all, we have to study what is the reason why analysts are making errors, and how that, what are features, what are how errors, what is analyst errors? So we calculated analyst errors by two measures. One is cumulative or relative level errors, when we take target return predicted 50 weeks ago and exclude historical at the moment t and divide it by the moment t. So we see like the percentage of the price which was not predicted at the time t. And then we take another approach, we take differential returns. So we take difference of logarithms in target prices, then difference of logarithms in historical prices, and then we take difference between these two. So let's start from cumulative relative levels errors. Next slide, please. So you see that one thing which we can say about cumulative returns, that these returns are very hardly correlated across different countries. So we calculated the same errors for France, Japan, Switzerland, UK, United States, S&P 500, and we also took MSCI All Shares, All World Index, and you see that in all cases the errors are very strongly correlated, and the peak of errors coincides with Lehman Brothers. Next slide, please. You also see that the distribution of errors is quite similar across different countries, and you see that there are very fat tails. So it is more often analysts are too optimistic about returns, so errors are positive. Next slide, please. So how can we use that? First thing which came to our mind is that we can use analyst errors, analyst predicted. So we actually find something which analysts really could predict. When they are acting as a crowd, they can predict the level of index, except situations when the market is in crisis, and nobody could predict crisis. This is black swan. So one of possible use is using in a single index model, in the simplest model of asset pricing, which is called CAP-M. So next slide, please. Well, I don't think that we really need to remind the essence of CAP-M, but just we have several students here. So the essence is very simple. Risk premium equals some exposure to market economy-wide market factor with positive mean. So actually the question is, what is that market factor? Because even if we take that the market factor is return of the stock index, we have somehow to find expected return of stock index, not historical return or something. And in that case, we really do have that expected return, because this is exactly expected return, consensual return of the index. Next slide, please. We see that the mean is almost positive of that expected return, and it is slightly skewed to the positive side. It could be described with generalized error distribution with some fitted parameters quite neatly. Thank you very much. Next slide, please. So, but when we tried to estimate single index model for different stocks inside S&P 500, we came to the conclusion that the fit of the model was very poor. In fact, it was more poor than the fit of the model when we are regressing return of historical index against historical price of the stock. So, in fact, it is hardly could be used in single index models, which actually speaks again another word against single index model and probably CAP-M theory. Next slide, please. So when we take differential returns, these are differential returns, several things interesting came to mind. So first of all, next slide, that we have long memory of errors, so we cannot predict the direction of error, but we definitely can predict the range of errors, the volatility of error, which means when error becomes big, it will become bigger with the passage of time, and when error becomes small, errors will be smaller with the passage of time. And we see that this is actually reflection. Next slide, please. This is reflection of very well-known stylized fact, volatility memory of historical returns, because you see partial ACF pattern is almost the same as in the case of errors. Next slide. And not of target returns, because target returns are really positively autocorrelated, but only with the lag 1. And it even has another interesting pattern, the negative correlation with the lag 2, which is not reflected in errors. Next slide, please. Can we actually predict analyst errors? Because analyst errors is the very issue which ruins performance of single index models. So if we can predict somehow when analysts are doing their errors, or when they failing to predict market crisis, then we actually are okay, because during all other periods they can predict the market, and we can use their opinions as an input to a single index model. Next slide, please. Previous slide, please. There is a very interesting market instrument which is called VIX, or volatility index. This is index of implied volatilities of options traded for S&P 500 index. So when analysts, the initial hypothesis was as follows: when analysts are expecting something, when they are not sure in their predictions, they exhibit more demand to the hedge, and when they are trying to hedge their portfolios, then inevitably implied volatility of options would increase, and so would do VIX index. So in fact, really, next slide, please. There is correlations of VIX and differential returns, but this is correlation without any lag. If we try to Granger cause, next slide, please. If we try to reveal the structure of causality between these two series, there is in fact a reverse relationship. So not historical, VIX does not impact historical, VIX does not impact analyst errors, but instead analyst errors are impacting VIX with lag 3. Next slide, please. So what we have at the moment, first of all, we see that aggregation of analyst opinions increases accuracy, we see that error covariates strongly across countries. We see that the use of predicted prices in single index model is very restricted, and the fit of the model is quite poor due to the crisis period. There is correlation with weeks, but very weak Granger causality, and direction of that causality is not is not what we have expected actually. But is there finally any use of opinions of analysts in predicting something? In fact, yes. We can see that when analysts start to, or the error of analysts starts to increase, we could expect increase of price of options. So the causality, the empirical data says that causality is exactly in that direction. And probably someone would take a chance and try to build options portfolios and to sell actually, to actually buy volatility in advance prior to big market events. So that's it.
Dear colleague, any questions to our presenter regarding to the report, its result?
Could you, can I have a question? Can I have a question?
Your questions.
Yes. Could you come back slide number 18? 18.
18? Mm-hmm.
Yes. Yeah, that's one.
Not.
That's one. Mm-hmm. Could you share with us more information about why we can see the high errors in the period of August 2009? In the middle, we can I see the.
This slide is not about analyst errors. The chart on this slide is VIX index, and the reason why I paid my attention to that index is that due to the fact that dynamics of that index is very strongly correlates. We could see it visually. It very strongly correlates to errors of analysts. So why it is so? The reason is very simple. Analysts are informing portfolio managers. Probably, this is, well, actually my guess, but I think that it's quite plausible. They are not only informing portfolio managers about their views on the market, they also are informing portfolio managers about their confidence in that views. And when portfolio manager receives from analyst the view with low confidence, he exhibits more demand to hedging his portfolio. And when aggregately portfolio managers exhibit more demand to hedging their portfolios, it increases market prices of options. And when we see increasing market prices of options, we in fact, all else equal, would see increase in implied volatility of options. And this increase in implied volatility of options is reflected in VIX, because VIX is naturally index of implied volatilities of different option series on one index, S&P 500.
Thank you. Thank you very much.
Summarizing the time of reporting and our discussion, I am forced to quit our discussion due to regarding to our Didenko presentation, and now it's time to report to our postgraduate student of Financial Market and Financial Engineering Department, Miroslava Dmitrieva.
Hello, everyone. Hello. we've discussed stocks, and now let's get down to foreign exchange and its high and extremely high volatility, which we observed on the Russian market for the recent years. Next slide. I would like to present the results of the research which was done among 86 Russian companies of non-financial sector. Actually, the companies were questioned. The questionnaire was distributed among the companies, and some companies' representatives were interviewed on how they manage their foreign exchange and interest rate risks, and do they apply hedging, and if they do, which instruments they use, what share of open currency position they hedge. So next slide. Yeah. Before the survey, several hypotheses were declared. The first one is that the importance of interest rate and foreign exchange risk in the largest Russian non-financial companies has significantly increased over the last like 4 or 5 years. And this hypothesis, as you can see from the slide, was confirmed. And one peculiarity was revealed. And basically this peculiarity is about that foreign exchange risk is way more important for Russian companies than interest rate risk. We could also observe this from the statistics prepared by the Bank of Russia, by this methodology, and by the statistic of exchange, of exchange. And we can see that there are 3 major factors which could describe the greater importance of foreign exchange risks in comparison to interest rate risks. The first one is that the majority of liabilities of Russian financial and non-financial companies is denominated in foreign currencies, and therefore companies are more exposed to foreign exchange risks. The second one is that there is no representative long-term ruble-tied indicative rate. There are some like Moskprime and Rulonia, but then they could be used for the hedging and interest rate risk management only for the in the short-term horizon. And the second one is that there are certain regulatory requirements to financial institutions with respect to hedging of open foreign exchange position. Next slide. The second hypothesis was about usage of financial hedging for interest rate and foreign exchange risk management, and we could see that less than 50% of the companies of non-financial sector apply financial hedging for interest rate risk, and in numbers it's 42% of respondents. And talking about foreign exchange risk, it's more than 50%, and around 60% of respondents would do so. This also could be used to defend the first hypothesis that foreign exchange risks are more important for Russian companies than interest rate risks. Next slide. But even though Russian non-financial companies, more than 50% of the companies apply financial hedging for foreign exchange risk management, it's still way lower than in other foreign countries. If we could see from the recent research which was done in developed Western countries, the share of companies is way lower than abroad. The key reasons of this could be divided into 2 parts. The first part is common reasons, which are applicable for Russian companies and for Western companies, is like insufficient risk exposure, use of alternative methods like natural hedging, high cost of financial hedging, and complexity of derivative valuation. But we have revealed some differences in reasoning of not using derivatives for hedging interest rate and foreign exchange risks. And to be mentioned, like for Russian companies, potential negative reaction from analysts and investors of using derivatives for risk management is not that important as it is for for foreign companies. Then the second reason is the majority of Russian companies, around 65% of sample companies, experience difficulties with hiring well and high qualified risk managers. And the last but not the least reason is that Russian companies consider low liquidity of secondary derivative markets as a suppressing factor for using derivatives. Next slide. If we look at the instruments which Russian companies use for foreign exchange and interest rate risk management, we could see that most of the instruments are from OTC markets. Like forwards is the most frequent used instrument for foreign exchange risk management, and swaps is the key instrument for interest rate risk management. Among others, we could see options, but they are least frequently used because of difficulties with pricing and non-linear characteristics of these instruments. Next slide. If we talk, then we analyzed like possibility of using different derivatives for risk management in Russian companies and on Russian markets. We could say that exchange traded markets gives quite good opportunities only for hedging only foreign exchange risks. If we talk about interest rate risk, we should mention that there are limited number of available derivatives. Basically, only futures are available for interest rate risk management, and limited number of available underlying assets. As I've already mentioned, there are no long-term like representative rates on the Russian market. About OTC markets, the statistics show that for interest rate risk management purposes, we've got only swaps, but this is like statistics, and we're not quite sure that it's correct because banks don't also quote some other instruments on OTC markets. And about foreign exchange risk, we can say that forwards and swaps are the most used instruments for foreign exchange risk management. Next slide. As we've seen, that OTC market is the only market which could be used for interest rate risk management, and the biggest market for foreign exchange risk management. We have analyzed the regulation of this market in Russia. As we know, it was in 2013 it was introduced that we've got like mega regulatory model on the Russian market, and it's Central Bank of Russia. And starting from 2013, Russia, as a member of G20 conference, decided to enforce repository and mandatory requirements to the companies to report about all registered transactions for the special regulator. And these functions are right now carried by NKO NRD, repository functions. So Russian companies need to report about all the transactions to that body, and if not, they're not able to do close-out netting, and they need to pay some fines. So that's it, an overview of the research which was done on foreign exchange and interest rate risk management in Russian companies. Thank you.
Thank you, Miroslava, for interesting report. And first of all, I would like to ask question regarding the using such a hedging instrument like forward trade agreement. How do you think why such from my opinion, useful instrument like forward trade agreement played so insignificant role in Russian hedging market?
So about forward rate agreements, it's slide number 5, I think. No, next one. Yes. These are the results of the survey, and it could also be supported by the statistics we've got on OTC market. As we know, FRAs are OTC instruments. But still, I would like to say that we've got 13% of Russian companies using this instrument, and probably this could be attributed to the fact that we've got centralized clearing of these instruments starting from 2013, and just 2013. So that's it.
Dear colleague, any other question maybe from our students? Please.
Miroslav, thank you so much for your content presentation. My question is quite general. As you have mentioned, the volume of derivatives transactions is quite increasing with the high velocity. So, my question is: will it harm in the long term the Russian economy and make it vulnerable to crisis? As we know, the vast majority of the instrument is devoted with the swap instruments, currency swap instruments. So will it be like similar to the situation like credit default swap impact on the United States economy and how it formed the mortgage crisis there? So will there any kind of serious threats for the Russian
economy? So actually, starting from that point when we had that crisis with mortgage-based securities in the U.S., I would say that since that time, a lot of regulatory changes have been carried, and now we've got, like, as I said, about repository and obligatory reporting to the special body about all the OTC transactions which companies have. And this would allow, like, Central Bank of Russia and some other regulatory authorities to control the position of the Russian companies with respect to those instruments. The second thing is that swaps we are talking about here is like interest rate swaps, and yeah, they are quite different from mortgage-based securities, as mortgage-based security have got like some underlying assets, which was like subprime. That was like one of the reasons, and here it has like nothing to do with some subprime mortgages, for example, loans. It just like a company has got a loan, yeah, and it wants just to swap their rates. Actually, I don't think that could be the same reason as it was like several years ago.
Any other questions? Our Vietnamese colleague?
Yes, I have a small question. Not, could you come back? Slide number 6. That's one. When I look at the picture, I saw the futures. The number of the company use the future contracts very small, just 3 or 4%. So could you explain why the future contract is less popular in Russia stock exchange? And the second question is, here you do survey on the financial companies So here you apply for almost the industry of the industry in the economy, right? So in among those the countries, which industries use the derivative contracts?
Excuse me for interrupting you, but dear Vietnamese colleague, can you express your second question more explicitly? Maybe type it on our SMS field.
For the second question,
Yes.
could you hear me? Could you hear? Yeah, for the second question, I wonder. I wonder, among non-financial company you are doing survey, which industries use derivative contracts mostly?
Okay. I got your question.
That's
So with respect to the first question about futures, why the share of companies using futures is lower than, I don't know, why is it lower than swaps and forwards? I think there could be two reasons. The first reason is that non-financial companies have some specific requirements with respect to their, I don't know, loan agreements and their planned and expected revenues and the timing of revenues in the future. And OTC instruments, as you know, allowed to include all the individual requirements of the companies, and that would be the first reason why OTC instruments are more frequently used by Russian companies. And the second reason is probably about exchange traded market, is that it's not that liquid as companies would prefer. Companies can hardly set up any static or dynamic hedging strategy on that market because of low liquidity and high costs associated with exiting the position, I think. And the second question, why non-financial companies? Because a lot of research and surveys have been done for financial markets, for companies of financial sectors, and for non-financial companies in Russia, there was done only one survey by PwC, and it's not that complex as it could be, and it's not that kind of survey which could be compared with foreign ones, like Wharton, Bodner, some U.S. Scientists. And the second question about industry, am I right? Industrial
Yes.
belonging? Okay.
Yes.
So the most of the companies are, as you know, our Russian economy, key industries are metals and mining and oil and gas. These are the companies who use different financial instruments and apply financial hedging in order to manage their risks. As you know, oil and gas companies are heavily exposed to both risks because all the revenue they've got is in dollars. And metals and mining companies is the same story. The industries where companies least frequently use financial hedging are services and trade companies.
Yes. Thank you. Thank you very much. Very, very useful information to us. Thank you.
Thank you, Miroslava, for your reporting and answering the questions. And before I accumulate our final conclusion, maybe somebody else would like to express his or her own opinion about our today's discussion. No one. Okay, so let me express my gratitude to all our participants and guests, and tell that we are very glad to have such interesting discussion today, and we hope that our cooperation will be continued to our mutual satisfaction. And I notice, and I hope that all our participants will agree with me, that our discussion was very interesting, was very fruitful, and mutually useful. So thank all of you for your participation, and of course we invite our Vietnamese colleague, and as far as I understood, our postgraduate student to be published in our magazine. Robert, sorry? And first step to it is to send your abstract and to send your report in appropriate form. We will write me to my email, you know it, and we will continue our collaboration. Thank you very much once more.
Yeah. Thank you very much.
Our webinar is finished.